Coming up today, stocks trade mixed, the latest tariff news, can the Mag 7 bounce back, GameStop gets into Bitcoin, and will AI and robots replace your job in the coming years and what you can do about it. You don't want to miss this one, guys. Let's go. And welcome back, everybody, to the Daily Market Review on quite a mixed day of trading here. In fact, we actually saw a sharp rotation out of defensive sectors. Healthcare especially, and a few of the consumer staple stocks, along with utilities. Pulling back a bit here today. Once again, it was tech leading the market higher. Tesla slapping on another 3.5%. Once again, the best performing large cap stock here again today. As the market continued its bounce, but ever so slightly today on really low volume and a really low range day. Volatility, once again, getting sucked out of this market. VIX almost getting down to a 16 handle today. And it's been absolutely crushed over the last 2 weeks here. But stick with me today because later on in this video, I'm going to talk a bit about the coming end of labor-based capitalism as we move into an AI robot-driven post-working world where most jobs will be replaced by AI and robots. And I'll show you how to work out whether your career is threatened by this and what you can personally do to hedge your own risks, as I believe this affects everybody. But first, let's just look at a little bit of data, the headlines, and we'll come back to the charts later on. And I'll show you what else I'm seeing out there today. Market's still not buying this bounce. We haven't even moved into the middle of the fear zone. Fear and greed index still at 29 here. And here's a visualization of past 10% S&P 500 corrections we've had that have gone on to turn into a recession and those that did not. You can see this has been one of the quickest and sharpest 10% corrections we've ever had, actually. And then typically the market can bounce around for a couple of months. Then we'll get some sort of recovery, but typically after 4 or 5 months since the correction has started, the market can plateau and roll over going into a recession. Kind of remember this pattern in late 2007 going into 08. And so if the market isn't able to reclaim all-time highs, which is a bit above 6,100 on the S&P, if we can't get there by Q3, Q4 at the latest, technically that's not a good sign. But we very well could bump around here for a few months, especially on the back of tariffs. But zooming out even further, we have this amazing correlation going on at the moment from when ChatGPT was first launched back in late 2022, which really set off this AI boom, kind of that pivotal point in history, the release of a mainstream chatbot. And so you can kind of compare that with the first internet web browser, Netscape Navigator. I remember using myself back in the mid-90s. That was released in late 94. And so just overlaying the two, looking at the NASDAQ composite, been following it pretty remarkably close. And if that were the case, and we are in this extended AI-driven boom, one could draw parallels between now and early 1997, when lots of people back then were calling the stock market extremely overvalued. Even the Federal Reserve chairman back then, Alan Greenspan, came out with his famous call in late 96. The market's showing signs of irrational exuberance. NASDAQ went on to triple over the following 3 years. And my gut feeling says a similar thing is likely in what I'm calling the smartphone bull market that I think will inevitably get us into bubble territory, and we could have a spectacular blow off top. Who knows, potentially 2027, 28, maybe even 29. I just don't think we've hit that big crazy peak in this AI-driven bull market, which is still actually young. But for now, here in the short term, tariffs dominate the headlines and what traders all around the world are keen off. But just looking at the forward volatility term structure and S&P 500 option, vols actually dropped down on what's said to be D-Day, 2nd of April, when reciprocal tariffs are set to go in effect. In fact, the market's pricing in more volatility for non-farm payroll next Friday. Once again, a little bump up there for CPI. And I'd say part of this bounce we're getting in the market is some positive developments. Not really reported too much in Western mainstream media. I actually had to go over to the India Today website to get some good details on what we've just heard today, that India is open to cutting tariffs on US imports worth $23 billion. Pretty positive sign and a good start. Like I said, this is inevitably going to happen. And I'd say Prime Minister Modi can already see the writing on the wall. And whilst he has to represent his country and their best interests, he's not going to rush to sign a deal in 2 days. If he gets one done, that'll be advantageous for his country and will get the ball rolling and incentivize other countries to get one done, especially their nearby neighbors, China. But others in Europe, they're probably going to need a bit more political pressure to come to the table, like they eventually will, because they're already getting signs of cold feet, sending over officials to US soil to negotiate directly with them, whilst also delaying implementing their first retaliatory tariffs on US goods by a few weeks. And then we did see a bit of a change in the price action of American stocks versus the rest of the world, especially yesterday to start the week. Strong bump up there after we've seen a huge rotation so far in Q1 out of US stocks. But what else has really been going on this quarter as we approach the end of it this week as consumers haven't been feeling all that great. As we got consumer confidence coming today, which did come in on the low side. However, it's yet to be seen whether that actually translates into the hard data, which is still holding up by far and large. Because we have seen this before, and a lot of these surveys can have a big political element in them and questionable of how they gather the data. Some of them only ask 1,000 people, and the people conducting the surveys may be wanting to push a narrative as well. That's why we look at the hard data, what people are actually spending and earning, because money doesn't lie. And just going to the Conference Board website and reading their official release today, Consumer Confidence Index did fall by 7.2 points to 92.9, but consumers' assessment of present labor market conditions actually improved a little bit. But the overall fall in confidence and other categories was driven by consumers over 55 years old. Contrasting that, confidence actually rose slightly among consumers under 35. Millennials, who are the next drivers of the economy going forward, and households earning more than $125,000 a year, their confidence didn't decline. And they actually represent over half of all consumer spending. What was also interesting to me and stuck out here is only 37.4% of consumers expect stocks to rise over the next year, down nearly 10 percentage points from February and 20 percentage points from the high reached in November last year. So a lot of consumers are bearish on the economy and the stock market. Are they right? Or is this a contrarian signal? Because a lot of consumers are worried about inflation, and no doubt structurally embedded inflation is still putting the pressure on many consumers, but actual prices in the economy are still only increasing about 1.8% annualized, and has actually come down a lot in the last couple of months. And so again, there's a big divergence, not only in inflation, but consumer spending and the stock market with how people are feeling and what's actually happening. If enough people feel bad and pessimistic, for sure, that can manifest into the economy and the market, which is why Q2 is probably important for economic data and the stock market to find its feet. Along with consumer spending, we'll be looking to hold up, but we are still getting some other positive signs out there. Not really hitting the headlines today, but still relevant. New residential sales of single-family houses came in pretty good. Seasonally adjusted annual rate of 676,000 for February. That's almost 2% above the revised January rate and is more than 5% above the same period last year, February 24. Median sale price of new houses sold in February 25 was $414,500. And there's a look at the 3-year chart of new home sales in the States. Holding up pretty good, especially when we go out 10 years as well. Now, this is a key indicator for the economy. Housing has a big impact. People buy new homes, they then furnish it and spend more money. And typically in economic recessions and going into them, you'll see new home sales fall off really hard. And we can especially see that going back to prior to the GFC. There's the boom in the housing market, the late 90s going into the early 2000s. Actually peaked out all the way back in mid-2005. It was already rolling over in 05, really came off in 06. That's how a lot of traders and hedge funds back then, as profiled in the Big Short movie, saw this data and a big divergence with the pricing of credit default swaps on mortgage bonds filled with subprime stuff, kind of like an insurance contract on a bond blowing up, which a lot of them did. So they bought those credit default swaps, and come late 07, early 08, the writing was on the wall. A lot of those bonds blew up and some of those funds and traders cashed in big time. But like we can see here, sales of new houses holding up pretty good. And since we're almost at the end of Q1, a couple of weeks into the new quarter, earnings season will kick off. Really be looking for the Mag 7. Morgan Stanley thinks they'll better stand up to the tall order the market's given them. Because we do have some positives like the weaker dollar. A lot of them getting large parts of their revenue offshore. That'll for sure help. And by far and large, actual consumer spending on advertising, capex on tech is all holding up, if not accelerating. So there's no reason why they can't come in with good numbers, but more importantly will be their guidance. Market will be looking to see whether they see any weakness in the consumer ahead. How's Q2 shaping up? But for the here and now, the media is still largely adding to the pressure on the market, especially stocks like Tesla, which it's losing the battle with. It was nice to see The Economist just come out with another hit piece on Musk. They make for a great contrarian magazine front cover indicator. Once again, talking up his competitors, focusing on the negatives, just like we recently saw in the Financial Times, actually trying to question Tesla's accounting. However, they had to backpedal that and issue an apology because the journalist didn't actually understand how their accounting works. Looking underneath the hood, all this recent attention and the likes of Tim Waltz jumping on board has just driven more attention and motivated more people to come out in support of the company. We're getting news that the new Model Y is already sold out in California, of all places. And the market was a little soft today, but Tesla still added on 3.5%. And just like that, we're already back at the 50-day VWAP on another good volume push here today. I'm quite confident the Waltz bottom is in, and I'd be surprised to see 220 taken out anytime soon. Plus, I think we may also be getting a little bit of a White House put on this stock as well. As they seek to backstop him, wouldn't be surprised to see some positive headlines or regulatory tailwinds come out in the coming weeks. But I'm not suggesting it's just going to be a smooth ride back to all-time highs. No doubt we're going to bump around here for a while, which is probably going to set up for a really good trading opportunity, especially in Tesla options as well. Moving on, and they finally did it. Possibly the easiest trade in the world. GameStop announcing to the market they plan on investing in Bitcoin. Kind of a no-brainer, right? With the board having approved adding Bitcoin as an investment, they just came in with fourth quarter results as well. Net sales 1.28 billion, a bit below the 1.48 analysts were expecting, but came in well ahead on earnings per share. They're still closing down stores, trying to turn the business around. Plenty of traders still having faith in Ryan Cohen, the CEO, to drive this company forward. And one thing they've done is dramatically cut expenses by trimming the fat. And that's what squeezed EPS up here. And it's going down a 5-minute chart after hours as I speak. Market seeming to like the result and news of adding Bitcoin up almost 6% after hours. And speaking of Bitcoin, almost back to its 50-day VWAP here, but kind of looking like the market. Bit of a soft volume bounce, which we may retrace over the coming days potentially and see whether the market can find its feet again. One good sign we do have is the growth commodity copper just breaking out to a brand new all-time high today. And for sure, some of that could have to do with stockpiling ahead of potential tariffs, but also I think it's a good sign of potential demand picking back up in China. The biggest consumer of copper, like they are in pretty much every commodity. And it's going out to a monthly chart here. There it is, breaking out above highs from last year and 2022 as well. Okay, over to what I was talking about earlier, the threat of AI and robots on many people's jobs and businesses as well. I don't think anyone is safe from the AI and robot threat. Who knows? Maybe there'll be an AI robot doing the daily market review in a couple of years better than I can. Anything's possible as we quickly approach artificial general intelligence. I think a lot of jobs only have a matter of years. Some of them are already being replaced as we speak. I've personally heard stories of some people already personally being affected by AI in their careers. And whilst there'll always be the need for some human jobs, specialists, engineers, managing programmers, I think a lot of jobs will disappear within the next 10 years. And that most people haven't realized this, especially in manufacturing. We've even heard a lot of CEOs are already planning now to cut jobs because of AI. Some jobs already affected: data entry, graphic designers, article writers. A lot of these little online gig jobs that were big business just a couple of years ago, a lot of them have dried up a lot. And that's why I said this mega trend is already happening, especially now we're on the cusp of humanoids going to start working in factories this year and next. I believe labor-based capitalism is coming to an end, or at the least dramatically changing, and we kind of go into a post-work world. Say kids that are born today may not actually be working in 20 years or so, unless they're really specialists. So we're likely going to move towards a universal basic income system. And I know that doesn't sit well with a lot of people, but it's just the way it is. Because businesses are driven by profits, and we're already getting price comparisons where humanoids will be a lot cheaper than humans, especially in warehouse and manufacturing to begin with. But as the technology improves, other industries, and of course we're a few years away from this, but they will eventually replace a lot of jobs. Cleaning, serving drinks, customer service, accounting. I think it's possible within 10 years we'll be having robots doing our dental work for us and other medical procedures. We just heard a couple of days ago a private school in Texas. They got an AI tutor for their students, which sent up their test scores to the top 2% of the country. Like I said, it's already making its way into many industries. And this isn't just the States. A lot of people don't realize how big robots are in China. They're advancing at light speed as well, as they also look to retain their lead in manufacturing. And so there's this cool website called willrobotstakemyjob.com. And you can enter your job and it'll give you a risk assessment of how likely it thinks a robot will take your job, with some being higher than others. And there's a look at some rankings. It's also got some charts, pretty cool data. And I'm not showing all this to you to try and instill fear, but rather to get you maybe thinking about it. If you're still working or run a business, how can you hedge this risk? Well, I'd say the first thing is to try and upskill yourself. Learn how to use AI. Don't deny it, but rather adopt it. Try and get ahead of the curve. Otherwise, the best way is to own a piece of it. This could very well cause wealth inequality to widen between asset owners and those on universal basic income, as I think the future will belong to those that own the code. Like I said, apart from there'll always be the need for some specialists and people to obviously run the robot companies and AI. And that's why on this channel, I've placed a big focus and will going forward on AI and robots and the opportunities it presents to us investors. We don't really have a wide range of choice as it stands. Obviously, Tesla, the clear leader and likely to be. A few other small early stage companies, a couple of large caps that have been around for a while, but still early days. But if this is to happen, which I think is inevitable, even though it might take a few years, then these companies will dominate. Kind of like how Amazon largely washed out the small family run retail businesses, which I can imagine back in the early 2000s. If you were running a local bookshop, the threat of Amazon was present back then. And I know everything's clear in hindsight, but let's say you were running a bookshop back in the late 90s, early 2000s. And let's say you had the foresight that the world was going digital. Books were going to be purchased online like they already were back then. You saw the huge growth in Amazon sales, and they were still growing during this period here in the early 2000s. Just the stock came off a lot in the bear market from the NASDAQ, off a real peak valuation. But let's just say you were operating a bookstore and you had this foresight that Amazon was going to absolutely destroy your industry. You sold the bookstore for $50,000 and you plowed it all into Amazon at an average of $2 a share. Well, since then it's been 100x. It's now over $200. So 50,000 back then would now be $5 million. Like I said, of course, that's perfectly clear hindsight, but it just shows what's possible for those that have some foresight and see the changes ahead of them, not behind them. Because no doubt the equivalent bookstore owners are out there today in many industries, and there's going to be companies like Amazon that come along and obliterate them. So whilst yes, you can upskill yourself, the best way to hedge is to be a part of it. Don't hate, but participate is my advice to anyone that's worried about AI and robots eventually coming to take our jobs and businesses, which I think for the vast majority of people, it's just a matter of time. And just wrapping it up here, looking at the market, like I said, did get a nice pop to start the week, but that was a low volume day. So was today. A little bit of indecision here in the market. Still have yet to see a really good follow through on the Russell 2000, although we're getting a nice bounce again today for the Mag 7. Big vol crush is good. Yield still bumping around with the 2-year at 4%. High yield bonds still holding on to their 50-day, and high beta stocks versus low volatility actually finding new highs again there today, but on a really low range day. And there's the S&P 500. So we've got GDP coming Thursday, core PCE this Friday. Market may key off that. Otherwise, it's still day to day with tariffs. If we get a negative tariff headline, we're likely to print a red candle. Otherwise, if we hear more positive developments, like what we heard from India today, somewhat signaling they're ready to concede, meet the states in the middle, then I think that's going to be more positive for the market, as we have heard from the president hinting at exemptions, willing to shuffle it around, suggesting a focus on US favorable negotiations rather than severe trade wars, which I've argued the whole time as well. Otherwise, we very well could bump around for another month or two. I would be surprised if we saw all-time highs any soon, unless we got the big blockbuster official trade deals that could easily send us to new all-time highs. Otherwise, until we get that, we'll be really looking for how Q1 earnings is going in a few weeks, guidance from companies, and whether the sour feelings from a lot of consumers materializes into lower spending going into Q2. So we'll keep doing our best to break down all the data and give you the bird's eye view. Otherwise, I hope you enjoyed this video. You're welcome to share your thoughts below in the comments, and I'll see you back here again this time tomorrow. Cheers.